From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
It's 30 minutes into the U.S. trading day on Tuesday, February 8th. Here are the top market stories we are following for you at this hour. Closing in on 2%. The 10-year Treasury yield inches higher, and traders see that nice round number in sight. It's just one part of a bond sell-off rippling across the globe amid expectations of more aggressive tightening. A plot twist at Peloton. The fitness company reports early, cuts its revenue forecast, plans job cuts, and announces its CEO, John Foley, will be stepping down. How does it all change the odds of a potential sale? And small business, big price pressures. NFIB optimism falls to an 11-month low with the weight of inflation and labor shortages. We'll take a closer look with Sharon Miller, Bank of America President of Small Business. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alix Steel is off today. Welcome to Bloomberg Markets. And Guy, you and I were just discussing, it feels like it should be later than the week than it is because the news flow just keeps on coming.
It continues to be brutal, and it continues to pull us in lots of different directions. What do you think? Do we get to 2% by Friday? Do you think we can expect that? We've got a lot of things to get through between now and then. Feels like a fairly big number, doesn't it? Let's talk about it. Kaylee, you raised the question, so let's dig into it. 2% is now in sight. Historically, 2% doesn't feel very high. But does it mean anything if we get to that kind of a level? Does a 2% yield really do anything for these markets? Well, let's kick it around a little bit. Kaylee and I have already been discussing it all morning. Let's bring into the conversation Kriti Gupta, Bloomberg Markets reporter, and Ira Jersey, Chief U.S. Rate Strategist for Bloomberg Intelligence. Ira, let me start with you. Does 2% mean anything? How quickly do you think we get there? And where do you think fair value even is right now?
Sure. So, three different questions. So firstly, 2% really doesn't mean a whole heck of a lot. In fact, if you look at most of the charts, we're actually right there at 1.97%, which is a very important technical level for these markets. And above that, we could very quickly get to around 2 1/8 on 10-year yield. So, 2% is kind of a vacuum kind of number either side of that. Where is fair value? Fair value is actually right around where we are. So our fair value model shows for 10-year yields around 1.92, but importantly, look at where tips are, because this whole move has been all about real yields. It's not about inflation. It's not inflation going up or the market expectation of inflation going up. It's all about the Fed and hawkish monetary policy, and real yields have gone up substantially. So watch those, and those currently are approaching our estimate of fair value at around negative 40 basis points on the 10-year. Right now, they're around negative 46 basis points.
Well, as Ira points out, Kriti, real yields moving higher. The equity market doesn't always take kindly to that. Right. Is 2% a bigger threshold for the equity market than maybe for the bond market in that sense?
It kind of seems like it would be, just given kind of the carnage that we saw in 2021. I think it was about a year ago to the date where you had the kind of the meme frenzy, the idea of 10, 14 basis point moves really rocking tech and, of course, the index broadly. But I think Ira was right here, and that 2% doesn't actually mean anything, not just for the bond market, but I would argue for the stock market as well. There's always going to be those kind of short-term fears, those near-term fears that 2% is going to be kind of the shocking round number. But if you actually look historically, when we have crossed that 2% barrier, I'm looking at 2013 with the taper tantrum after Ben Bernanke made that congressional testimony, yields shot up over 2%. They were actually below before then. Same story in 2017, right before the trade war. You also had this kind of growing in line with yield. So yes, immediately on that knee-jerk reaction, you did see a little bit of a sell-off, but it kind of or what's the word? It kind of shook it off his shoulder, whatever the phrase is.
Shook it on the chin.
Yeah, there you go. It kind of rallied after.
There's a British way of saying that, Guy.
There's always a good British way of saying everything. Kriti, Ira brings up inflation and says that this isn't about inflation, this move that we're seeing right now. And certainly if you look at the price action, particularly in tips, you can see the justification for that. Nevertheless, we're coming up to the big inflation print of the week. We're looking at CPI. And I'm wondering kind of which assets are going to react the most to that. Is CPI going to be something, if we get a expected or higher print, going to be enough to push us through 2%? Equity markets are starting to sell off now. Do we get a bigger reaction there? I'm wondering how inflation is going to be priced later on this week into the asset classes that we're tracking here so carefully. Where do we get the bigger reaction, bonds or equities?
Yeah, can I take a third option and say the dollar? Because I think that's
Credit.
really where it's going to be the big one. The idea here is that the bond market is, of course, going to react to the CPI print, no doubt about it. But the equity market seems to lately, at least in the last couple of months, been taking their cue. The idea that it was kind of spooked by yields in 2021. Well, in 2022, it's spooked more by oil prices than anything else, which, of course, is the driver of those inflation prints. And typically, when we get those CPI prints, you actually see CPI beat the surveyed estimate. So it's kind of that assumption that they're going to beat, and they're going to beat by a huge amount, or the CPI print is going to beat by a huge amount relative to the economic surveys that you are seeing. So that's the kind of mentality the S&P 500 or equity investors are going to be going into the print with. The bigger move is going to come from the dollar, especially because they're kind of dealing with those haven flows that are ongoing, the idea of rate differentials essentially, but also the inflation prints. And I think if you start to see a higher spike in the dollar off that CPI inflation print, that's ripple effect is what you're going to see in the S&P 500 and commodities as well, just given that they're priced in those dollars. So I'm going to use that third option, Guy. I think it's the dollar.
Guy, if I can jump in here just for a second on that. Yeah. So if you think about, my fear is that if we do get a higher than expected, say something close to 8% on headline CPI this month, which is a non-trivial possibility, that what probably happens in the rate market is you get a significant flattening of the yield curve, and that probably will affect risk asset markets pretty significantly. So it's like the second order effect is, the curve flattens. People say, oh, the bond market is saying that we're going to have a recession next year, and that's going to hit risk assets. So credit spreads wider, equities may be somewhat lower on the back of recession fears for a 12-month forward look.
All right, so CPI, one potential catalyst this week, Ira. We also have a significant amount of supply coming online. When you look at the auction slate, you got 3s today, 10s tomorrow, 30s on Thursday. What are you expecting in terms of what that takedown could be like and the resulting move in the bond market?
Yeah, it's hard to love these auctions, right? So we will be watching very closely what the bid to cover ratios are and who exactly gets these bonds. But remember, the Treasury Department is cutting them. So they just cut them another couple of $1 billion. 20-year next week is actually cut by $4 billion, and they're going to continue to cut auctions for the rest of this quarter. So I do think that there is a risk that that's the impetus when we get the 10-year auction tomorrow, that you could push to you could finally see a print above 2%. In fact, the when issued issue for the 10-year is right around, a little bit under, but very close to 2% right now. So this new 10-year might be the catalyst for that 2% number to finally be hit.
Kriti, I want to come at this from a European angle as well and figure out what is going on globally. We have seen since last Thursday a huge repricing in European bond markets to reflect that pivot that was delivered by Christine Lagarde. To what extent is that playing into this rapid move higher that we're currently seeing in the US 10-year?
Well, a good chunk of it, I would say. Like the latest leg higher is actually coming from essentially what you saw in those periphery yields, the Italian spread to boons, especially actually influencing what the yields are going to be doing. And that's really where you're seeing this kind of get closer and closer to that 2% level. That doesn't mean it's going to continue, though, because I think as you start to see more commentary coming from the Fed and a little bit more clarity about whether or not we get that 50 basis point hike in March, which I think is the real question when it comes to the U.S. bond market, at least on the surface level here. And when we're talking about those cross-asset correlations, the idea that the bond market is still pricing in a 50-50 chance of a 50 basis point rate hike in March. And I think that clarity is what's going to move the needle more than what you're going to see from other central banks around the world.
Well, Kriti, to that point, I feel like I'm seeing more and more notes out from strategists at different Wall Street banks essentially saying we've seen it all priced in at this point. This is peak hawkishness. It doesn't get any worse from here. Yeah. Do you get that sense looking at where these markets are that it's all baked in already?
It's interesting that you say that because that's what people said about the Bank of England, and yet you saw a pretty interesting reaction, right? They said it was all priced in. Yep. We know the Bank of England was very hawkish, and then here we are. And then the reaction was, well, the ball's now in Lagarde's court, right? That what the ECB does is going to create that currency moves more than anything that the central bank does. If you apply that same logic to what you're seeing here in the Fed, the idea that, yes, the Fed seems to have taken this hawkish tone, well, it's not just them, right? It's the entire world, and they're trying to target inflation, which if you look, and once again, I'm going to go global here. If you look at these attempts to target inflation from central banks around the world, emerging markets, which are far more exposed to those commodity moves than other countries, they've been trying to do this for months and months on end. This is why the Fed is behind the curve, right? Because they've been doing this way before the Fed even decided to admit that transitory wasn't worth using, the word wasn't worth using anymore, and yet they still haven't done it. So I think the bigger question isn't necessarily, is the Fed going to hike, is the Fed actually going to be tackling inflation?
Very good question. Thank you so much to Bloomberg's Kriti Gupta and, of course, to Ira Jersey of Bloomberg Intelligence. And Guy, of course, to Kriti's point, it's not just if the Fed will hike. It's also a question of how far they will have to. With the market reacting like this, how much work has the market already done for not just the Fed, but central banks across the board?
And the market's reacted really quickly, and I think this is significant as well. And it's now starting to creep in the credit markets as well. And I think that's the real tell here in terms of the way that the market maybe repositioning a little bit faster than the Fed is in some ways. If you start to see credit reacting, if you start to see that transmission mechanism being affected in the United States, then I think that is something that the Fed will pay attention to and will maybe have to sort of lean against in terms of it's about the pace here that I think is important. And that's what's really catching my eye here. The credit market's beginning to move. Is the Fed going to be comfortable not with the move, but the pace of the move? Bond yields are going higher. Is the Fed going to be comfortable with the pace of the move? 2% I don't think is particularly relevant, but how fast we get there I think is. And what does that tell us about ultimately where the terminal rate is going to be as well? Yeah, how comfortable will they be with a flatter curve as it persistently flattens? Definitely questions we will try to answer. And we'll talk about with our next guest coming up who thinks we may have been at peak hawkishness already. Where does he see us going from here? And what role does the retail investor have to play in all of this? We haven't seen them buying like this in about a year. We'll talk with Vijay Patel, the global macro strategist at Vanda Research, about that next. This is Bloomberg. $196.14. That is where we currently sit on the 10-year Treasury yield, getting closer and closer to that nice, clean, round 200 basis points. But our question of the day is, would a 2% yield actually mean anything? We're joined now by Vijay Patel, Vanda Research Global Market Strategist. Viraj, obviously we like round numbers. It's something that we can mark to and pay attention to. Does it actually make a difference whether we're at 2% or 1.99%?
In reality, probably not, especially for the Fed. I think really here, whilst it's really difficult to be a dove in a world of hawks at the moment, we do think that we really are approaching peak hawkish Fed. And there's a couple of reasons for this. I think, one, just in terms of what's baked into the front end, this aggressive front-loading tightening is a narrative that we would want to start fading. All the talk around a 50 basis point hike is not what we see on the cards. We really just want to get that first hike out of the way and effectively see a buy the rumor, sell the fact across yields. But really what's going to be important this week is CPI, and especially tomorrow's CPI print. We think that it could come in on the softer side, especially given a lot of the factors that have been driving the upside, things like new and used car prices. We're starting to see them moderate. So, the Fed had this peak, I guess, in inflation coming in at the second half of this year. If we start to see signs of that earlier and as early as tomorrow, then I think that will be a real big wake-up call for both the Fed and markets, especially in terms of what the Fed can actually deliver in terms of rate hikes over the next couple of months.
Viraj, I hear what you're saying about peak hawkishness, but nevertheless, the inflation print is going to tell us that we are still well away from where the Fed's target is, and as a result of which, the Fed is going to have to take some remedial action to get there, and that probably means taking interest rates north of 2%. We haven't fully priced that yet. Even at the front end, we haven't fully priced that yet. So isn't there more room to go in terms of yields going higher?
There's a couple of ways in which this plays out, really, over the next 2 to 3 years. On the one hand, yes, I think if central banks wanted to just take interest rates straight to 2%, in a linear fashion, back-to-back hikes, like what we're seeing priced in the UK, that is one option. But, as we've learned from the post-GFC era, really, gradual and limited, it has always been the phrase. And we don't see any necessary need to veer from that messaging too fast, too quickly. At least in terms of where the landing zone is for inflation. As I said, if the top comes in slightly earlier, if we get towards a period of goods deflation this time next year, energy-based effects working their way out of the CPI print, we could be in a very different inflationary environment, one that optically looks, bad for the Fed to continue tightening in an aggressive manner. So, I think markets are really underestimating the scenario where central banks get a couple of hikes done, pause, see how the economy digests that, and then waits to get the sort of second wind of rate hikes at a much later stage.
So what does that mean for the equity market, Viraj?
Yeah, I think we're getting close to a really constructive environment for growth and tech. For one, obviously, if yields do start to, at least the momentum in the sell-off in the bond market starts to wane in the next couple of weeks. The second factor is really positioning. We've seen a huge capitulation in positioning, especially across all US equity investor types, based on our indicators here at Vander. And I think that coupled with a peak in yields at some point, would be a really constructive environment for growth in tech stocks. One factor that we've also seen is retail investors buying, and that's going to be constructive as well to that environment for growth.
Well, okay, so let's just dig into the retail side of things. Viraj, what have retail investors been doing during January into February? We've obviously seen huge amounts of volatility. Growth stocks have been hit particularly hard. Have they still been buying? What have they been buying? And would you expect that buying, as you suggest, maybe to shift back to growth if they've been picking up other areas once we start to see the environment you suggest will come to bear?
Yeah, at Vander, we've noted this is a really different retail investor to what we saw pre-COVID. And, I think there's a lot of people on the street waiting for that capitulation to come through. Look, we haven't seen it over the past month. We estimate that net purchases by US retail investors has been around $30 billion. And that's equivalent to what we saw this time last year, at the heights of the meme stock rally. So, retail have been buying the dip pretty aggressively, especially on days of heavy selling. But on those rally days, what we've noticed is that all the buying has been focused on large cap techs. In particular, this phrase that we've coined here at Vander, TAN stocks, Tesla, Apple, AMD, Nvidia, these new large cap tech stocks, which has been effectively the darlings of the retail investor world. That's where all the buying has been focused on. And that's probably where all the buying is going to be focused on in the next couple of weeks if we get a bottom in equities.
Okay. We'll see what causes that bottom in equities maybe to form. Viraj, always a pleasure. Nice to see you on the show. Viraj Patel, Vander Research Global Macro Strategist. What are we going to be talking about next? We're going to dig into some of the corporate news we've been watching. Shares in Pfizer, a little lower today. The drug maker's latest forecast for sales and profitability coming up short. Details next. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Rishika Gupta. Big changes are on the way at Peloton, the fitness company whose share price plunged after a slowdown in demand. Peloton co-founder John Foley is stepping down as CEO and will become the executive chair. He'll be replaced by the former CFO at Spotify and Netflix, Barry McCarthy. Those moves are seen as a victory for activist investor Blackwell's Capital. Peloton also said about 2,800 jobs will be cut. The Australian electric vehicle charging company Tritium will build its first U.S. factory in Tennessee. President Biden and Tritium CEO Jane Hunter will make the announcement today. The plant will be located east of Nashville. It's expected to create 500 jobs and make as many as 30,000 electric chargers a year. Pfizer forecast 2022 sales and profit that fell short of Wall Street estimates. The drug maker's expectations for its coronavirus vaccine and recently cleared oral therapy disappointed investors. Pfizer's $100 billion plus target for this year would mark a record high for the company. And that is your latest business flash. Guy Keeley.
Rika, let's pick up on that Pfizer story and talk about it a little bit more. Wall Street was really bullish on what was expected from Pfizer, and you just wonder how we ended up with this gap in expectations versus reality. Let's try and kick this around a little bit. Sam Fazeli, Senior Pharmaceutical Analyst for Bloomberg Intelligence, joining us now. Sam, how do we end up where we are right now, which is a big drop in Pfizer's share price? Wall Street was expecting a lot. To be honest, Pfizer delivered a lot, but not quite enough. So how did we end up with this gap? Was it a communication problem, or was Wall Street just simply getting ahead of itself?
Yeah, hi guys. So when I look at the numbers, we have detailed estimates on Bloomberg MODL, which we can look at. You can see that the estimates they've given for Comirnaty, which is their COVID-19 vaccine for 2022, is about 2 billion shy of what consensus was looking for. So it's at 32 versus 34. And Paxlovid is at 22 versus about 25 that consensus was looking for. The question I have is, why did anyone think that consensus was going to be right on any of these numbers? If the company had all they had done was say, this is the number of doses we're going to make, That we know about Paxlovid's price in the first contract they did with the US, and that's about it. So how these numbers fall, I think, is what consensus had obviously got a bit too excited about. Now, could they do better than this? I think so. I think they could do better than this, especially on Paxlovid as the year goes on. But let's see what they say in the call with regards to the average pricing, if they ever make a comment on that.
Well, one reaction from Citigroup was about its dependency on COVID treatments and vaccines in particular, saying, quote, it remains the challenge and the opportunity. Is Pfizer at risk of becoming too COVID oriented here?
Well, not really. I mean, they have two of the best products out there with regards to a vaccine and a drug for COVID. That's just the way it is. So let's just celebrate that. But in reality, what's happening underneath, if you take this layer of COVID away, is business as usual. Some products didn't do well because they had pressure from COVID, etc. So the company has a lot of pressure on now to utilize this cash flow in a good, accretive way. And that's going to be the interesting thing to see, because it's not going to last forever. At some point, we'll end up just taking an annual shot, perhaps, if you're over 60 or whatever. So that's the critical element here. What are they going to do to get the rest of the business to motor?
Sam, what does this mean for BioNTech out of Germany? What does this mean for Moderna? What do we learn about what is happening in the wider pharmaceutical market today? And what do we learn about what the long-term trajectory, as you say, is for COVID treatments and how maybe that's going to fade a little bit?
Yeah, so for BioNTech, it's relatively easy. It's not that easy because it's not like they take half of what Pfizer make in terms of gross profit on the vaccine, and that's their revenue, because they sell direct into Germany and Turkey. They also have a deal in China with Fosun. So it's a bit more complicated what exactly they receive. But obviously, if Pfizer gets less, then they'll get less in terms of sales. For Moderna, it's a lot simpler. If Pfizer's doing X amount, then I think people will assume that Moderna will do just a little bit less. So for all of these vaccine makers, we're still going to be having this question, Guy. What are we going to need in terms of further shots throughout this year? And what does that mean for next year? If shots that have been contracted this year don't end up being used, does that then fall into 2023?
Mm-hmm. All right, excellent questions. We'll look for answers. Thank you so much to Sam Fazeli, Senior Pharmaceutical Analyst for Bloomberg Intelligence. And as we know, COVID has impacted inflation and the labor market. That affects small business. We'll discuss that with Sharon Miller, Bank of America President of Small Business, next. This is Bloomberg. We're about an hour into the Tuesday U.S. trading session, and as usual, Abigail Doolittle is here following the moves. Abigail, it's less exciting in stocks today, more about the bond market.
It is certainly more about the bond market. Right now, we have stocks fluctuating between small moves, or at least small, modest mixed moves. Bonds, though, it's very clear what's going on. We're looking at a bit of a sell-off. This is a 10-year yield over the last year, actually from the last year, and you can see right now, almost at 2%. We've been talking about the possibility of 2.25, even 2.50 on this program. Well, there is 2%. That, of course, brings into question valuation on tech stocks, also the cost of money for companies, higher prices for consumers. But right now, stocks are doing relatively okay, especially, not surprisingly, bank stocks. Take a look at JP Morgan, Bank of America really eating that up. As yields go higher, of course, can help their lending activities. Oil is down a little bit today on the idea that perhaps geopolitical tensions are easing. So you can see some of the big oil names are down. One stock that's not down, in fact, up for a big way for a second day. Here's Peloton. Take a look at this over the last 2 days, now up 41% in the pre-market after reporting a very disappointing quarter, also announcing a new CEO and organizational changes. The stock had been flipping around, but right now up about 12%, up more than 12% actually, because yesterday up about 21%. So big gains for Peloton. Largely has to do with the speculation that the company will be taken over by another company. Investors, longs, probably relieved about this because this is the new range in terms of revenue, down sharply from the prior forecast and the estimates. EBITDA profit, a much wider loss than had been expected. And then, of course, subscribers of 3 million, down from what had been expected. But again, Guy, the big story in Peloton is the idea that perhaps a company, maybe Nike or Amazon, those names have been thrown out, could acquire Peloton.
Was this enough to keep the activists happy? Are the activists going to be wanting more? Are we going to see other C-suite executives maybe having to depart as well? Abigail, thank you very much indeed. Let's turn our attention to some of the data we've seen, really relevant to the US economy and the trajectory we're on. Inflation and labour shortages certainly weighing on the minds of small business owners in the United States. The latest report on small business sentiment is out. The NFIB data released a little earlier on your Bloomberg terminal. Bloomberg's international economics and policy correspondent Mike McKee joining us now to sift through what we should take away from these numbers. Mike, what's the big takeaway?
Well, the big takeaway is that small business owners are starting to get less and less optimistic about the economy. As you can see here, the optimism index, the white line, has declined to 97.1. That's below the average for the NFIB numbers, and it's way below where we were before the pandemic started. They see profits falling, and as you can see with the yellow line, expansion plans have been put on hold. They're going down. And the biggest reason is they can't find workers. Here's the survey's top problems for small business owners. Labor quality and shortages, 23%. They can't find the workers they need. Inflation is now up to 22%, right behind it. They're paying more for what they've got. Labor costs are going up, not quite as fast as their prices, but they are going up. Now, here's the interesting thing. This bears on what Abby was just talking about, higher interest rates for businesses. Only 1% say credit, the cost of credit or the availability of credit is a problem. 62% say they have no interest in borrowing right now. What are they doing about their problems? Well, they're doing what you'd think they'd do. Right now, you can see the number of jobs open in white drops just a little bit, but it's still 47% have jobs open that they cannot fill. And the quality of work is a problem. The availability of labor is a problem. 55% say so they are raising prices. That's the yellow line. 61% say prices are going to go up to try to keep profit margins worthwhile.
All right, prices of everything seem to be going up. Thank you so much to Bloomberg's Michael McKee. And let's get more on the state of small business now with Sharon Miller, Bank of America's president of small business, as well as head of specialty banking and lending. Sharon, given some of those pressures that Mike was detailing to us on the labor side, on the inflation side, from your view, how resilient are small businesses right now?
Well, we did see a decline in the data for the NFIB reports that just was released. However, we still see improvements when you look at the comparison year over year. So small businesses do remain optimistic. We are seeing in our own data that our deposit balances are up year over year. We're seeing demand for loans out there, and we're also seeing payments at record levels within the small business space.
In terms of what needs to happen, though, to bring supply and demand into balance, Sharon, demand is incredibly strong. Is the expectation, do you think, the demand comes down? Or do you think we're going to see some of these bottlenecks, be they labor or materials or whatever it is, starting to ease? Is there an expectation that some of these bottlenecks start to actually fade as we work through the rest of this year?
We do see and anticipate that some of these bottlenecks will begin to fade as the year moves on. We do still see, as you indicated, supply chain issues. Of course, inflation is a big issue. And I think the most relevant and what we hear about so many times, not just this report, but every time we survey our business owners, it's around finding the right labor. And that has just been even a bigger issue throughout this pandemic, getting the right skilled labor to go to work in small businesses across the country. They just can't fill the jobs that they have open.
Well, and do small businesses have more difficulty outsourcing or shifting towards automation, things that maybe larger scale companies could do in the face of labor shortages? Do they have the ability to do that?
They do have the ability, but I would say that it is more difficult in the small business space. You know, when you're competing against global corporations, it is very difficult to really keep up with the investment in technology. And so we have seen our small business owners, in fact, continue to invest in digital capabilities. And especially during the pandemic, those that had digital capabilities and were able to go online and be able to create the goods and services and really distribute those goods and services across the country through digital means, it is those fared much better. And at Bank of America, 85% of our small business clients are digitally active. And so when you think about the capabilities, the tools, and the resources for small business owners, not just so that they can really protect and grow their business and get through this pandemic to the other side, but also using that as a way to distribute their commerce. We're seeing more and more of that, especially coming out of the pandemic.
Sharon, what's happening with inventories? Clearly, we're seeing shortages everywhere at the moment. Are these small businesses having to dedicate more working capital to inventories to make sure that they can navigate some of the supply shortages that they're seeing? And how significant an increase are we talking about?
Yes, I mean, there's certainly a pressure on inventory. You can just go to order a furniture or a car. You're waiting months and months. So this is an issue for the consumer. And for a small business, balancing, do I have the right inventory? Can I meet the demand that's out there? This is what really is that juggling act between the two. Now, we're just coming out of the holidays. And so as we talked about the January data from the NFIB report, we do tend to see a decrease because you've got a lot of demand going on throughout the end of the year in the fourth quarter. And then going into January, you do see a bit of a lull. So, although the NFIB data was a decrease versus December, I don't see it as alarming. I would say it is what we normally tend to see in the trends.
And obviously, when we're talking about inventories and the capital needs, that brings me to a question of where that money is coming from. Are you seeing small businesses being more active in seeking out loans? What does loan growth look like?
We are, and at our company, we are seeing loan demand begin to increase. We have seen pre-pandemic levels when we look at the comparison for our balance sheet for small businesses and what they are doing to access capital. So our clients are coming to us, they are accessing capital. And as you talked about this segment in the beginning, we did hear that there's not an issue so far of business owners. That's not one of their top issues in getting access to capital. And so we are seeing more and more demand that is coming. And I think it has to do with getting more inventory, taking advantage of some of these opportunities that are out there as we come out of the pandemic, and clearly hiring more employees and wage pressures.
Okay, but let's just dwell on that issue of the availability of capital. The availability of the money is certainly there. What's the sensitivity, do you think, to the cost of money? If we see the cost of money starting to go up, and we spent the program talking about 2% yields on a 10-year, clearly there is a rising cost of money right now. Where do you think that starts to have a significant impact on small businesses? When do you think actually they start to maybe reduce their desire for attracting fresh capital into the business? At what point does that come?
Well, we're still at historic lows as far as rates go. So yes, we do see sensitivity to that, but I'm not anticipating any time in the near future that would cause some sort of strain or constraint on access to capital for small businesses. We see that the demand is continuing to grow. We are at historical lows in terms of interest rates, whether you're applying for a small business loan, a mortgage, an auto loan, all of that, really, we are at historical lows.
Well, and Sharon, obviously, when we're thinking about the cost of money, a lot of that is influenced by the monetary side and conditions becoming less easy on that front. We are also experiencing simultaneously a lack of fiscal impulse that we have seen through much of the pandemic. And I'm wondering, especially as so many of these businesses are raising prices, consumers have to be tolerant of those price increases. Are we going to start to see a bit more difficulty on that front?
Well, there are raising prices. When we expected that, when the cost of goods and services are getting to, where inflation is at 40-year, where we're seeing increases in all of that. So I do think that you have to pass that along to the consumer. Small businesses cannot hold on to that. And so we have seen an increase. And then on the flip side of that, it's sort of a tale of two cities, because we do see consumer spending. We just released a report yesterday on consumer spending of our clients at Bank of America is at record high. Payment rates are at record high. We're seeing small businesses continuing to spend. And in fact, that's up 22% year over year. So as you think about the demand of goods and people having money available to spend, our deposit balances are continuing to grow, both in the consumer as well as in the small business segment. And that, again, is up double digits from last year. So all of those point to there's a lot of cash on the sidelines. There's a lot of money to be spent. And we know that consumers fuel small business. So as consumers spend, as we see more goods and services out there, and as supply chains go abate a bit in this year, we will see the matching of goods and continuing of improvements overall for the economy.
Yep, and such an important area when it comes to labor as well. Half of private sector jobs in small businesses. So the health of this sector, critical. Sharon, it's always great to get you on the show to talk about the NFIB, to talk about what you're seeing in your data. Really appreciate your time today. Thank you very much. Sharon Miller, Bank of America, President of Small Business. Greatly appreciated. What do we got coming up for you? A shake-up at Peloton. The fitness maker replacing its CEO, cutting hundreds of jobs, got an activist investor, indicating it's not enough, though. Will more heads have to roll? Details next. This is Bloomberg.
Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. The U.S. is losing patience with China regarding trade commitments reached during the Trump administration. American officials say they haven't seen any real signs of Beijing making good on its agreements. China pledged to buy an extra $200 billion in U.S. agriculture, energy and manufactured products through the end of 2021. After taking on Spotify, musician Neil Young has set his sights on big banks. Young has called on baby boomers to, quote, ditch the companies contributing to the mass fossil fuel destruction of Earth. He proceeded to encourage people to take their money out of JP Morgan Chase, Citigroup, Bank of America and Wells Fargo. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Guy.
So we've got Neil Young, Christine Lagarde, and a whole host of other central bankers. That's an unusual Venn diagram, isn't it, Kaylee?
It absolutely is. I mean, Neil Young has made his fair share of headlines in the last week or so. First, you take your music from Spotify because you don't like Joe Rogan's podcast or Spotify's response to it. You actually see your music actually getting somewhat of a lift off of that, even removing Spotify from the equation, now taking on the big banks. And to read off the quote here, Guy, he said, join me as I move my money away from the damage causers, or you will unintentionally be one of them. So he's definitely taking an activist stand here, but I think it broadly goes to the idea of big banks, their role in financing the fossil fuels industry, and what that means from a regulatory standpoint as well.
Just from a markets point of view, though, the energy sector is having a cracking start to the year, and the banking sector is having a cracking start to the year. So just in terms of investment advice, that's a tricky one.
Maybe don't listen to Neil Young on that.
Yeah, so the music, fantastic. The investment advice, maybe a little bit different. From an ethical point of view, well, that's a whole different argument. Let's talk about something else we should focus on as well, talking about things that are changing pretty fast. Let's talk about Peloton. The stock is all over the place. That's the one-year chart. But just look at the right-hand corner. There is what looks like a fairly diminutive spike, but in percentage terms, that's absolutely enormous. Now, we've seen overnight this news coming out that there's going to be a huge shake-up at the fitness company. That's now reached the C-suite. We've got the CEO stepping down, a new CEO coming in. Talk that maybe we're going to see other C-suite exits as well. What does this all mean in terms of the idea that potentially we could see an acquisition here, changes coming? Well, let's go to San Francisco and bring Ed Ludlow into the conversation. Ed, what is this? What are these changes a recognition of? Are they a recognition of that there is now a need for an acquisition, or are these changes a recognition that the company just needs a different direction?
Yeah, I mean, the stock move is crazy, right? And I think you take each of the actions in isolation. So first off, John Foley steps down as chief executive officer, becomes executive chairman. This is a company that he founded a decade ago, right? 2012. For those on global Wall Street that want to see this potential takeover happen. I think that, Foley stepping aside increases the likelihood that a Nike, an Amazon, potentially an Apple or a Disney could come in with a bid, right? Because
Ed,
of the dual class share structure.
Well, it's talking of he still remains a shareholder. He has those super majority shares. So don't you still need his sign off for any deal?
Well, that's why I point out, remember, he's the founder of this company, and it's a decade in the making, and a lot of it was around psychology, right? He personally has come under attack from Blackwell's, the activist investor. They've issued a statement basically saying, we're happy that he's stepping aside. We're not happy that he's hand-picking directors for the company. So that's one point. The other point is who comes into the seat, right? Barry McCarthy, a well-respected former CFO of Spotify and Netflix. You have JP Morgan saying that this guy has credibility of the street. He's proven that he knows how the subscription model works. And remember, before the idea of an M&A, an acquisition, a takeover came about, the whole conversation was, what is the future for Peloton? Because it's grown to a point where it can service levels of demand in terms of the hardware, the bikes, the treadmills, that just aren't there anymore. So they wanted to see somebody that could reinvent Peloton to more of a services and higher margin revenue business.
Ed, my real question is that the famous San Francisco fog behind you, or is that some sort of steam duct? Because that's the big debate now on this show, because it looks really cool, it looks amazing.
It looks mystical.
I'm going to let you guys on a little TV secret. That is actually real. That is what San Francisco looks like every morning. The Silicon Valley glow is still here.
All right. Well, Guy, you and I seem to be in the wrong place. I'm sitting here in my studio. It's kind of cold in here. And I know London's always gray. So, Ed Ludlow, you get the better end of the stick there. Thank you so much for joining us from a beautiful San Francisco where the sun is rising. Appreciate it. This is Bloomberg.
It's time for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. I'm Ritika Gupta. SoftBank plans to go ahead with that IPO of ARM. Now that NVIDIA abandoned a proposed acquisition of the chip designer, both regulators and customers were opposed. It would have been the biggest deal ever in the chip industry. Harley-Davidson reported a surprise profit in the fourth quarter. Results were boosted by higher prices for Harley's iconic motorcycles, plus sales rose 8% in North America, offsetting declines in the rest of the world. And the latest threat from Meta Platforms doesn't seem to have European officials worried. The company has again warned it could pull Facebook and Instagram from Europe if it is unable to keep transferring user data back to the US. Bloomberg caught up with EU's competition chief.
I'm on Instagram, and if it doesn't work anymore, that would give me maybe another 10, 20 minutes per day.
Vestager says that threats are never a good idea with the EU. Regulators from Europe and the US are in negotiations to come up with a new data transfer agreement. And that is your latest Business Flash. Guy.
Ritika, thank you very much indeed. We start the count to the European close now. Let me give you an idea of what the price action on this side of the pond looks like. European stocks negative now, down by 0.1%. Earlier, we were really quite positive. Kind of the early couple of hours of trade, things were certainly moving in a positive trajectory, and then really quite a steep roll-off as we've entered the afternoon. In terms of what actually I think the price action tells us right now, it is that we continue to see the focus on the bond market. And you can see what's happening with BTPs. The sell-off continues. Yields continue to track higher. You've got a big move in the UK. You've got a big move in Italy. It's really a story that we are watching very, very carefully. It's interesting we're focusing on the US approaching 2%. I find it fascinating that we still have Italian 10 years trading below the United States. Tells you a lot about what's happening with the various central bank price action that we've been seeing, i.e. buying up a lot of bonds. Brent crude, probably the biggest feature in terms of the story over here in Europe. The lead losing sector today has been one of the big outperformers that we've been watching so carefully over the last few months. Energy falling today because energy is falling today. Brent crude down by 2.5%, but obviously we've seen a meteoric rise. We'll talk more about commodities in the next hour. We're going to get an idea of what is happening with these markets. Should you favour Europe? Do you go back into the United States? Caroline Simmons, the UK CIO at UBS Global Wealth Management, joining us next. The countdown to the close starts next.